Yo, what's going on everybody? My name is Ryan, I'm a CPA, and today we're having another edition of CPA Reacts because why the hell not? You know, people keep doing or saying dumb shit, so we will keep reacting to it. All right, so let's jump right into it. This first one was a popular TikTok video, and I know as I say TikTok video, that's already a red flag. But this one is basically a girl who refused to round up her money at Panera Bread. You know, sometimes when you go to a retail store, they ask you to round up your money so that, you know, any difference will be donated to charity. So this girl refuses to round up to give to charity because she says they make you give them money so they can donate it to charity, so they can write off on their taxes and get all that money back. It's a scam. There's that, and then in the comments below, someone smartly says write-offs don't work that way. So she's upset over something that's not happening. And then the response to that comment says, they do work that way. Company takes my money and donates it on behalf of the company. Now the company can write off their charity. Basic economics, he says. Basic economics, wow. Okay, so first of all, no, it does not work that way. Lady, girl, whatever you want to be called, who's getting upset over nothing. If you round up to charity, if you round up your bill to the nearest dollar and, you know, Panera donates it to charity, Panera is not taking a charitable deduction, okay? And even if they were taking the charitable deduction, you say that they get all that money back. That's not how taxes work either. But, you know, that's a whole nother discussion. So technically, you get the charitable deduction on your taxes if you round up your money to the nearest dollar that subsequently gets donated to a charity. Obviously, you want to keep the receipt from Panera Bread in order to prove that, but you know, who's going to claim like 54 cents of a donation on your tax return? You know, that's so either way, you're not really doing it for the tax purpose anyway. You're doing it because you are caring for others and for your community. So hopefully that's why you're doing it. But now you created this stupid viral video that half the people believe and the other half are smart enough to know that's not how that works. How does Panera Bread record something like this on their books? So basically, if you round up your money to charity, let's say it's 54 cents, Panera Bread will report it on their books as a liability. Yeah, it's not going in as income, it's not going in as an expense, it's going in as a liability. So it's going to accumulate all these little minor cents and, you know, sub-dollar donations here and there. It's going to build up this liability account, okay? And then once they actually donate it to the charity, they're going to obviously give them cash, and then they're going to debit the liability account, which reduces their liability account on their books. So as you can see there, it doesn't hit their profit and loss statement at all. It doesn't affect their taxable income. It doesn't give them a deduction. You know, originally it increases their liability, and then when they donate it, it decreases their liability. That's it. That's how that gets reported on the books for these companies. If you think maybe they are cheating somehow, they're not reporting it properly, well, first of all, Panera is a publicly traded company, so they are required to follow, you know, financial accounting standards. So, you know, but let's say they weren't a public company and you think that they're cheating their books or somehow putting it on the profit and loss. Well, the only way to make that happen truly, well, one of the ways to make that happen is to report the extra donations as income, the rounding up amounts, the 54 cents as income, which would therefore increase their taxable income. And then if they wanted to take the deduction, they had to report the expense, which would then decrease their taxable income. So it's still a wash on the profit and loss statement. So there's no scam here. And then the absolute gall of this douchebag below, it's basic economics. That's the problem with what's, you know, this kind of shit that's spreading on the internet, is people are so sure of what they're saying when they have no fucking idea, none at all. So don't be like these two idiots. Do your research, think critically, don't just post stupid videos, you know, because you have, you know, because of technology now, you do have a pretty wide influence on people. And so use that power wisely. All right, this next question is from a tax professional forum. A child was born in 2020. The person is filing a 2020 tax and wants to claim him. I explained to him that this is not possible. Can he claim him? Are you freaking kidding me? This is a tax professional. He's saying a child was born in 2020. The person is filing a 2020 tax return and wants to claim the child. Yeah, of course you can claim the child, dude. If you are a tax professional, you should know this. Basically, if you have a kid, anytime before this, on December 31st or before in that year, you can claim them for that year, for the year they're born. That's the first year you can claim them as a dependent. But if you're trying to file a 2020 tax return, but the child was born in 2021, then you can't claim the child for 2020. That's because the child was born in 21. You know, we're going off of calendar years here, you know, basic concepts. So this guy is an idiot because he's a tax professional and he's asking dumbass questions like this. Don't be like this guy. All right, actually, same person right below asks, can an employee with a W-2 deduct expenses if they work from home? First of all, are you even a tax professional? What is happening here? You used to be able to deduct these expenses if you're a W-2 employee. On your Schedule A, you used to be able to take mileage deductions, you know, work from home expenses like business use of home, your home office expense, and various, you know, meals and entertainment that you take out your clients and stuff. That used to be able to be done on your tax return if you're a W-2 employee. But since the tax reform, the Tax Cuts and Jobs Act of 2017, those expenses have gone away for W-2 employees, and work from home expenses, home office expenses, or whatever you want to call it, are only available to, you know, self-employed people and some, you know, S corps, partnerships, that kind of thing. So no longer available if you are a W-2 employee. Biggest trade of my life. Took out a $76,000 loan for this trade. While we tour Asia, our money will work for us. We're up almost $8,000. So for context, this is somebody who I'm friends with on Facebook. They took out a $76,000 loan to invest into Bitcoin. You know, a day after this post was made, Bitcoin tanked. This guy deleted his post because why would you keep it up there? You did something stupid, broadcasted it to the world, and now it's biting you in the ass. So why this irritates me? Because people sometimes think it's a good idea to take out loans to invest money. You know, that's actually a really stupid idea. Even if your loan is like 1% interest, so here's the thing. All the finance majors that are in college right now or newly grads are gonna probably tell me, oh, but you can make 10% in the market, you know, over the course of your life. Each year you have 10% average. If your loan is, you know, 1%, 2%, 3%, even 4%, that, you know, the difference in interest income that you have there will benefit you because you're making more interest than you're paying out in percentages. So yes, the math checks out that way. That's true. If you borrow money, let's say at 2%, put it in the market, and you earn 10% each year, the math technically checks out. However, what that equation fails to consider is risk. So the more debt you have personally, the more risk you're taking on as an individual. And of course, you know, every person has different risk tolerances and all that. I'm not a financial advisor. I'm not going to get into the details, but I'm going to give you some scenarios that could happen where you might be totally screwed if you borrowed money out to your eyeballs to invest. Let's say you borrow money, $76,000 at 2%, and you put it in the market or in cryptocurrency, which is even dumber because it's more volatile. You put it in the market, market gains 10%, so you're netting 8% each year, which is a good number, right? You're netting 8% gain. However, let's say a pandemic happens, okay, which, you know, is not so far-fetched now, but let's say a pandemic happens and the market tanks, okay? Now you got to leave your money in there because if you pull it out, then you realize those losses, right? So you want to leave your money in there to ride out the recession and hopefully get back to a normal bull market. However, because it's a pandemic, your hours were cut, or maybe you got laid off, or maybe your job was furloughed for several months. So now you have to live off of no income, but all your money's in the market that's tanked now. So do you have to pull out your money and realize losses, take out another job, find other jobs? You know, what do you have to do? All the meanwhile, you have to still make payments on this loan you took out to invest in the market, you see? So that's what I mean by taking on more risk by borrowing more money. Even though you can borrow more money, even though you can borrow money for a low interest rate and invest for higher gains, I think it's a terrible idea, because when you're in these tight situations, you're going to be stressed to your eyeballs. You're going to be making decisions you wouldn't be making had you not had any debt. And you're going to be stressed out trying to figure out what kind of jobs you need to take, whether or not you should pull the money from the markets. If you're investing in something like Bitcoin, which, you know, super volatile, and you took out a loan to do that, that has got to be one of the dumbest things I've ever heard. Okay, so there's that. Also, if you have a mortgage out, if you have a loan on your car, something I wouldn't do is I wouldn't invest aggressively in the market while you still have that debt, because that is technically borrowing money to invest in the market. Although it might not seem like it, but because you have a car, you know, you have a car loan for your car. But if you were to pay that car in cash, then you wouldn't really have that money to invest in the market. So what you're doing is you're borrowing money on your car to invest in the market. You know, think about it this way. If you had a paid off house or a paid off car, would you then put a mortgage on your house and then take that money and invest in the market? That's essentially what you're doing when you are aggressively investing while still having debt. Okay? So that's just irritating me. Thanks for listening to my rant. Again, my name is Ryan. Please consider subscribing to my channel if you haven't done so already. And if you found this video helpful or entertaining, please smash the like button, share with your friends, share with your family, all that crap. And I hope you stay safe for now. I'll see you next week, and take care.
Move for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker.